Hey guys, Mike here. So I got another jam-packed video for you. We're going to look at some charts and what I think people are expecting to happen this year, which wouldn't be the first time it happened. And I'll show you exactly what I'm talking about in a very similar instance in the past. But, with a lot of data, I want to show you something. One thing I think that made Friday so quiet was it was OPEX, but look at the amount of options. Look at that right there. I mean, only 79 million option contracts. And you can see what normally happens on OPEX is more, and of course you saw in January. I mean, look at that right there. It was huge. And one thing that's going on now is, I'm seeing a lot about this, is look at the VIX call option volume right now. That is huge. We hadn't seen this much since 2018, and people are definitely expecting something to happen because the VIX has been so muted and kind of suppressed right now. And so they are expecting some kind of major volatility event to happen. Now, what's going to cause that? We don't really know because it wasn't the Fed meeting, it wasn't PPI, it wasn't CPI, it wasn't earnings, and so there really is no other earnings that should cause that. But again, we've been on a nice run and people are expecting something to happen, right? And you have this huge spike in the VIX. When that happens, usually, obviously, the S&P sells down. Now, understand a lot of this is hedging, right? People are hedging against their longs positions and stuff like that. And so, does that mean something's going to happen? No, it doesn't at all. But some people are saying because of these ODTE options, that's something that's going to cause, they call Volmageddon. I think that's what it's called. It happened in 2018 with another similar like product people were buying and stuff. And, we'll have to see. Again, a lot of this is hedging, but it doesn't mean big money can't make it happen. We've seen that before. So just be aware of that if you do see it. Now, something I do want to go into is, and this is something I did videos on this like months ago for the members and stuff. This came out the other day, and that's why I'm going to tell you about this. This is multifamily units under construction, right? And it's hit basically a level we hadn't seen since 1974, I believe that is. And this could be for a number of reasons, but one thing I want to tell you, and a little backstory here is, again, one of my neighbors is on the commercial side of construction, so he builds like public storage units, things like that. And then the other one, he is on, another friend we have, he's on the construction side as far as residential, right? And so one thing that happened was the friend on the residential side said it was very strange. His company had been ordered to start building more multifamily home units, and he designs all the roofs and stuff, right? And our friend over on the commercial side said, hey, one thing you're going to see before a recession hits is you'll see a lot of apartment complexes going up and a lot of storage units. And I was like, really? Why? Because obviously when recessions hits, that's when people usually end up losing their homes, right? And they have to go to an apartments, and then they have to also downsize. So where do they put their stuff? In public storage units. Now, so I was like, really? I was like, okay, that don't make any sense. So I started looking into it, and I looked up like what would be one of the biggest apartment complex companies and then the biggest public storage unit companies. And shockingly, this is what I ended up finding. This is public storage stock right here, right? And they're the largest in the country. Well, of course, what's happening right now is you're seeing a breakout. Now, is this the breakout? I'm not sure, but one thing to keep in consideration here is if we go back, look what happens when we go into like these downturns, right, before we hit these recessions. Well, the stock usually breaks out because you're going to build these units before recession hits. So if you see it on the horizon, you're going to start building beforehand, right? So they're ready to go. Also, what do public storages do? I think they're trying to buy another public storage company as well and load up here. And you can see, I mean, it's pretty nice moves. And remember, I mean, a lot of stocks, what they do during recessions, they go down. But obviously, if you're going to be used a lot, make a lot of money, and I looked at their financials, and they were really good during these times that I showed the members months ago. And then here's another one. This is during the dot-com bubble, right? It breaks out, boom, you see a recession, and it just skyrockets during the recession, right? Because I guess everybody's downsizing, putting their stuff in there, right? And then I did use Equity Residential, but then I started using UDR, which is another apartment complex company. And you can see it's had a huge breakout, by the way, currently. But if you go back and we just look back and like, '08, same thing happened, right? You get that trend line, gets a nice breakout. Obviously, we don't know the recession is actually happening at that point in time because, again, this shaded area is not going to be there until officially a year later sometimes. But you can see, nice breakout there. You saw it '01, broke out. Both of them broke out before the recession ever hit and stuff. And so again, the earnings look really good. Why? Because people were downsizing, losing their jobs and all that good stuff. Now, does that mean that's going to happen again? Again, we shut down the world, things are off. But it is interesting to see, because if we're going to get a recession, when are people expecting now? The second half of the year, maybe early 2024, if it's going to happen at all. And so, just something to be aware of. So in a way, it's kind of like, is it an indicator? Has been in the past, right? Could it continue to be an indicator? It could. So again, watch out for there. Watch out for that. And plus, if you're looking at investment, if we actually do hit recession, then those are two things to look at. Now, the other one to watch out for is XLE. And XLE, obviously, we're in a different time with the constraints we have and everything as far as production and stuff. But you can see that trend line's held up really well. And you can see this is the second highest point it's ever been at. It's broke it 3 times. And there's the highest it's ever been, which is not far away at all. And if we just scroll back, you'll see it's right there. 2014, was it? We hit it. And the thing to look at when you're looking at XLE is these trend lines. Because when they break, and usually it's during a recession, boy, they break hard. I mean, this thing just crashes and burns. It's like you can see in 08 right there. Normally it crashes and burns in a recession because obviously demand's not there, right? But this right here wasn't in recession in 2014. But you see the drop. Like once that trend line, because it is so well respected, once it breaks, another one to keep on your list, it breaks, and it breaks hard. Now, is that going to happen this time just because we have an issue with supply? We're going to have to see and make that out. But it's another indicator that, hey, you might actually officially be in a recession if that happens. And guys, if you get anything out of this, please hit that like button. It really does help the channel. And if you're new here and you like this kind of content, think about hitting the subscribe button. I really appreciate it. Now, that leads me to what's happening now, right? Which is this tug of war between bulls and bears. And of course, there's people like me who just follow data and you're in the middle kind of looking left and right. And like, what the heck's going on? There's these arguments on both sides, like, hey, we're heading back down. The other argument going on, though, is look at what's going on with the 200-day moving average, right? And people are sitting there looking at this. Remember, we broke the 200-day moving average about 2 or 3 weeks ago, I guess it's been. And you can just see and count the days you want to. It's been above the 200-day moving average, right? Which usually signifies you are out of a bear market when this happens. And I'll show you what I'm talking about here. And, of course, you got the golden cross as usual. But you can see right here, this was the 08 crash. And you can see once it broke above, you see it come down and test it a few times. But then it just takes off, right? I mean, especially after the golden cross happens and it doesn't come back down and break it again. So that's what some people are arguing. Look at the amount of days, right? And then this, of course, is going to be the dot combo when it finally bottomed out. But once it got above the 200-day moving average, it never came back down and retested it. So, that's something to keep in mind. This is the 90s. You see the same thing. Once it broke above the 200-day moving average, that was it. Never came back down and broke it again. And then, of course, you look down here in the 80s, you get the same thing, broke above the 200-day moving average and kept going. And so we'll see. I mean, the 200, it's powerful, right? Nothing good happens below the 200, and a lot of good stuff happens above the 200. But again, we are in different times. That's when it's really hard to try to compare, but that's all you can do, right? It's look and go, yeah, when this happens. And that's what I'm saying. The algos are trained for this. Traders are trained for this. Investors are trained for this to understand above the 200-day is actually a good thing, not a bearish thing. Below is bearish, right? And so that leads me into what, other people are expecting, right? I think a lot of people are expecting what I'm about to say to happen, okay? And so remember, I always said you get one golden cross. Well, according, since the 1970s, that's been true. Is that going to stay true? We'll have to find out. But looking at what happened in the 70s, very similar time where you had high inflation, high Fed funds rate, right? And then looking at that chart, and then that's what's going on now, right? High inflation, high Fed funds rate, which will eventually, I mean, of course it takes its toll on not just the economy, but earnings. That's just the way it's going to be. And, how the market's going to react to that, we'll have to see. But if you look at this, and again, it's tough to compare times. I understand that. But if you look at the 1970s, which is about the most comparable time you're going to get, this started on January 3rd. And if you come down on 1977, January 3rd, and you come down, it's one of the most, I guess, smoothest channels you can find throughout history compared to what we have now, right? Which is this smooth, orderly sell-off and stuff. And when it comes down, obviously, you end up getting your golden cross, breaks above the 200, and never comes back down again. But look what happens. I should say never comes back down again. Well, it comes back down, all right. But it's months later. It's in the second half of the year is when you get this crash down below the 200, right? And it's about, what was it, a 15%, I believe, 15% drop. So we didn't go back into a bear market and test the lows, but we did end up obviously breaking the 200, and 15% is a big drop on the S&P. Well, when you look over, and if you compare that to what we got going on now, you can see started on January 3rd, nice smooth sell-off into the channel, of course. And as everybody would describe it, it's been nice and orderly. And then, of course, We end up moving up, breaking out of the channel, end up having the golden cross and everything. You can see it's choppy, and it's going to be choppy. There's no doubt about that. But I believe this is what people are expecting. They're just expecting this move up, and as earnings contract, as these rates and inflation you can see is sticky, starts to take its toll on the consumers. Obviously, we'll be able to build by less services, build about less products and stuff like that. That will take its toll on earnings. And then you'll end up seeing something similar where we'll just be all over the place, coming up to a new high, new low, new high. And all of a sudden, the second half hits, and boom, we end up coming back down when people realize the Fed is going to hold the rates where they're going to hold them, and there will be no cuts, and it will take its toll. And we will break below the 200. Whether or not we get a death cross, who knows on that one. But I think that's what people are expecting. And it doesn't make sense. Yes, what's the X factor that we don't know about is employment, right? Again, we've never had this kind of worker shortage before, and we've never seen, obviously, the first time people over 65 and over, that population is growing while the age of the work age population is not. It's basically just flattened out and even curving over at one time. So that's a whole different ball game. Now, one thing that's going to take its toll, and we're lucky, one thing that's keeping the ball rolling really and not causing the catastrophe or this big, huge crash everybody's calling for right now is the debt, right? And I'm talking about corporate debt here. You can see in 2023, this is in trillions. In 2024, sure, that looks like a lot of debt. But compare that to 2025, 2026, 2027. That is a mess. Like, if we're setting at these rates at that point in time, we're in deep, deep trouble, right? Because that's $2.78 trillion in 2025. Here, and this year, you're looking at less than $1 trillion and just a little over $1 trillion in 2024, the rollover. So the CFO did a great job, and they took all that free money out, basically at almost zero rate or zero interest, to sit there and make sure they put it out to 2025 and 2026. So hopefully they could refi before then on lower rates, which you can definitely expect we're going to be in lower rates. There's no way. I don't even see, and let me know in the comments what you think, but I mean, our economy, our system, it just isn't set up to operate at high rates anymore. It just isn't in my mind. But, let me know in the comments if you think that's wrong or whatever. And again, it is a little less than $1 trillion in corporate debt a lot this year. Absolutely. That's why you're seeing bankruptcies through the roof. There's a lot of zombie companies out there, unprofitable, high debt, right? And so, are you going to see more bankruptcies? Absolutely. I mean, I already showed you how they started off already. There's no doubt if they especially if they keep raising and maintain it the whole year. Oh yeah, a lot of companies, you can kiss them goodbye, right? They're gone. And so, how many of those are publicly traded? I don't know. But, and again, 2024, again, is over $1 trillion a lot? Yeah, because it's not only a lot, that's what they have now. Imagine all the debt that's going to have to be taken out to continue to function, right? And so, especially if consumers start to roll over, and again, we'll have to see. I have a friend come overnight who works for the bank, so hey, I'll ask him about that. But, again, we'll have to see on that. It's all got to do with, and I tell people all the time, as long as you have a job and they're able to pay those credit cards, because yes, we just came out with a record. Every month it comes up that, our finances, the debt is at a record high. But it doesn't matter as long as you can pay the credit card bills off. That's all it is. As long as you pay that minimum, whatever it is, and a little more, pay your mortgage or your rents and your car loans and all that stuff. And guess what? You still ain't got no student loan bills, at least for probably till June. So again, you still got that reprieve. None of it matters. That's just the truth, And so when that cracks, when you start to see those job openings shrink down to 1-to-1 or whatever it is, especially when it goes less than that, and people start losing those jobs, oh yeah, I mean, there's going to be a nice little reckoning, no doubt about that. But remember, what did firms think? They thought that was going to happen in 2022, and it hasn't happened. Now they're pushing it back to the second half of the year. That also has something to do with this rally, right? And let us come out of that channel and everything. They go, oh, everything's great. No, everything's not great, but they just screwed up. They put the cart before the horse. They got too far ahead of themselves, right? And so now they're pushing us up. And again, so if things get bad in the second half, they'll just sell it back down. So that's what a lot of people are expecting to happen. Doesn't mean it's going to happen, right? One thing you learn about markets, if anything, you look at any chart, man, they can remain irrational and disconnected from reality for a long period of time. Right? I mean, retail has never been buying in. We thought 2020 was big time. And I keep saying, remember I said, this reminded me of 2020. Well, now retail's buying it in at an even faster pace than 2020. And so, and I will ask a question you can put down in the comments. People talk about AI and robots and all this stuff and, how that's going to be good. And my question has always been about that. And, I'm all about technology. But the last time I looked is a robot or artificial intelligence software, whatever, doesn't collect a paycheck, which means it doesn't pay taxes, which means it doesn't buy houses or cars or groceries or clothes or anything like that. It doesn't have children, which are future taxpayers and future consumers. And so, the big argument is, well, it's going to create more jobs. And I'm going, I understand, because I think it's Ark Invest and Cathy Wood, they use, I think it's the tractor, I believe, is what they use as the example. And it's the dumbest example I've ever seen because, and the reason why I say that, not to be mean, is because the economy was a baby, right, when they invented the tractor. And so, yes, the tractor made it where they could obviously harvest a lot more crops. So you had to start building a lot more facilities, right, to be able to handle all the demand, right, and for cotton and everything else. But now we're a very mature economy, right? And so not growing anywhere near as fast as we grew for those decades coming forward. And so my question is, when you automate taxis, like what job is being created for those taxi cab drivers who just lost their jobs, right? You're going from point A to point B, whether it's Jimmy doing it or a robot doing it or, automated nothing doing it. What job just got created? Like, I don't understand. There's nothing different happening. What happens when you automate 18-wheelers? Well, where does the truck drivers go? What job just got created? Because you still got to go 65 miles an hour on the interstate, right? So I don't know, man. I guess people go, they don't have to sleep; they can drive through. Maybe, but I'm still trying to figure out what job is being created. I'm just asking, like seriously, just asking, because I don't know the answer to it. But I keep thinking about it. I don't see it. I see you losing taxpayers and consumers. That's what I see us lose when that happens. Because what do you see happen to the auto industry? Yeah, I mean, Bob and Billy and Susan, they came off the line, right? And so the robot stepped in and did their job, but where did they go? What job? Man, I know they went to the picket line, but what job got created? And so that's what I'm just, kind of curious about. I understand the 60s, 70s, and 80s and 90s that happening, but now, really? I'm like, I just don't get that. I'm sure there'll be some jobs created, but I'm just trying to figure that one out. Like, what's going on? Let me know in the comments or whatever what you think. And that's a whole nother video I'd love to do one day, just talking about that because yeah, it's great as far as being for companies because they're cutting costs. But I'm still just trying to figure out what jobs are actually going to be created to make up for those jobs we just lost. Because whether you like it or not, you got to have taxpayers, future taxpayers, and consumers and future consumers, right? That's just how this works. And so just curious. Let me know what you think down in the comments, guys. Anyway, hope you guys have a good day. Tomorrow, it's President's Day, I believe. So kids are out of school, and we'll be having fun. And if you got anything out of this, hit the like and subscribe button for me. I really appreciate it, guys. So I'll see you tomorrow, okay? And we'll set it up for the very, very short week ahead. So anyway, have a good one.